Reinvestment risk is the risk that returns from your investments, like dividends or interest or coupons or even the rent that you receive from your rental property, will be reinvested at a lower rate of return than the initial investment. In other words, reinvestment risk is the risk that the returns from your investment, whatever cash flows you receive from your investment, when you'll be reinvesting it, remember I told you that you need to keep reinvesting so that you can compound your interest. So this is the risk that by the time you receive your whatever cash flows you're receiving from your investment, be it the principal or the return on your investments, and you need to reinvest it so as to earn more revenues or so as to grow your wealth, the rate at which you'll be earning from the reinvestment will be lower than the original investment. In other words, you have invested in a bond earning you coupons of 17%. So the reinvestment risk in that bond is that when you receive this coupon at 17% and you want to reinvest it, the rates will have come down to 11%. Or at the end of the maturity for that bond, when you will need to reinvest it, the rates will have come down. The opposite is also true, that at the time when you receive your cash flows, when you receive your bond, when your bond matures and you receive the monies, the rates will have gone up. Of course, where there's a risk, there's a gain also. So also a possibility that when your bond matures, or when your investment matures, or when you receive the cash flow from your investment, the rates will have become better, and so you stand to gain better. But the purpose of this video, specifically today, we are going to be discussing reinvestment risk. My name is Belin. Please press the subscribe button if you haven't subscribed so that you don't miss out on these informative videos that I put out every so often. In today's video, in today's episode, we are going to specifically discuss reinvestment risk. I have already told you what it is. We are going to be going through which investments exposes you to reinvestment risk and how can you mitigate this reinvestment risk. Let's have a look at this example. Somebody says, I do have 500,000 shillings in treasury bills since September and it's short term, 3 months via KCB. By the time of application, it was 16.7 interest and 16.7%, and as per the latest news all over, rates have come down. What should I expect? Can I reinvest with the same compound once the 3 months are over? So this investor is telling us that by the time he or she was investing, the interest rate then was 16%. Now, this is a treasury bill. It has a fixed tenor. The tenor has matured. And now at the point when now she or he needs to reinvest, the interest rates have now come down to 10%. So she's moving from, or he's moving from a scenario where his investment or his asset or her assets was earning, let's go with she, where her assets was earning her 16.7%, and now she's standing a risk of this asset now earning her, going to earn her 10% if she chooses to reinvest in the same asset, in the same investment vehicle. That's exactly what reinvestment risk. The risk that you invest 500,000 in a treasury bill, and then when it matures, the rates will have come down. So the risk that you are going to, and that when you reinvest this 500,000, you are going to earn less, 10%, as opposed to the 16% which your initial investment was earning you. So how can you mitigate this risk? Which ways do we have that will protect you from reinvestment risk? One answer is already in that example. What do you see? Tell me in the comment section, how can you mitigate reinvestment risk? From these examples that I have just read out for you, someone invested in treasury bills, a 3 months paper, let's assume even it was a 6 months paper or a 1 year paper, and now at the point of that treasury bill maturing, the rates are at now 10%. So initially she was earning rates, she was earning at 16%, now the rates are at 10%. How can this risk how could it have been mitigated? The first way to mitigate is long-term investments. Picture this scenario. If we had two people, we have a Casey and we have a Kirsten. Casey decides to take a treasury bill at 16%. Kirsten decides to take treasury bond at 16%. Who is going to be predisposed to reinvestment risk? Between Casey, who is investing in a 1-year term paper, and Kirsten, who is investing in an 8-month term paper at the same rate. Now, certainly, it's Casey. Why? Because 1 year down the line, Casey's investment will have matured. And so Casey will be predisposed to the risk of rates having come down and having to reinvest her assets or her finances at a lower rate. The risk that when you earn your dividends and you needed to reinvest it to buy more shares, by the time the dividends are being paid out, the share prices are up there. And so if you are to buy more shares, you're going to get less shares. So how do you mitigate it? Of course, like I've told you, going for the long-term investment assets. I mean, investing for long-term durations, longer durations. For instance, when the rates are higher, rather than taking the short-term papers, go for the long-term papers. Invest in a fixed long-term security like the treasury bonds. Yeah. Now, you also need to avoid callback bonds. What are callback bonds? A callback bond is a bond where the bond issuer has a right to recall that bond from the market and pay you your investment and then reissue that bond at a lower rate. For instance, well, gladly CBK does not issue callback bonds. But for instance, if CBK was to issue callback bonds, or if Kenya was to issue callback bonds, it would mean that bonds are issued at 16%, and then when rates come down, like now they have come down to 10%, you are paid your investment. CBK pays you back your investment in that bond, and then they sell another bond at the lower rate. So if you invest in a callback bond, in a callable bond, it will mean that you will be exposed to a reinvestment risk. So if you want to avoid this risk, then you need to avoid such bonds which can be called back. Another way of mitigating reinvestment risk is through portfolio diversification. This is where you invest in different asset classes. You have your bonds, you have your treasury bills. So you have your treasury bills, you have your bonds, you have your MMF, you have your investment in a circle or savings in a circle. You have though I don't classify circles as investments. They are more savings to me than investments. You have your investment in shares, your rates, your property. So when you have it all diversified, you are already mitigating that reinvestment risk, because when one asset is underperforming, when one asset class is underperforming, then you have the other asset class to invest in. When rates are down, when interest rates are down, you can then be boosting your investment in the shares. All right? When you receive your dividends in your shares and the rates are favorable, then you can invest whatever amount you have received in the shares in the dividend, whatever dividends you have received from your shares in the bonds, or you can then buy more shares. So portfolio diversification would also help you in mitigating reinvestment risk. Another way of mitigating reinvestment risk is through bond laddering or laddering your portfolio. All right? You have maturities that mature at different times. Now, I want you to picture a scenario where you have 5 million, you have invested in treasury bills, maybe you spread it out within the 3 months, 6 months, and 1 year treasury bill, and then they are going to mature pretty much the same year. And at the point when they're maturing, like in the example where we had, the rates have come down. That is going to predispose you certainly to reinvestment risk, because you are going to have to reinvest it at the prevailing market rates of 10%. How about if instead of taking the 1-year investment opportunities in the treasury bills only, you had taken up the bonds, that the 20-year bond, the 17-year bond, the 16 or the 12 months, the 12 years bond or the 10-year bond that had higher rates of 12%, 14%, 18%. It will then mean that your investments, your assets is going to mature at different times. So while you're going to reinvest certain amounts at a lower rate, which is the risk, other assets are going to mature, or other papers are going to mature when the rates are higher. So then instead of having all your 5 million reinvested at 10%, you are going to have probably just 1 million reinvested at 10%. And by the time the other papers mature, the rates will have gone up, because remember, interest rates are fluctuating. Today they are down, the next day they are high, and we don't know at what rate, at what point they are going to start, the curve is going to take the opposite turn. All right. So bond laddering or asset laddering is also another way of mitigating reinvestment risk. So understanding reinvestment risk is one way of mitigating your risk. And also, it's also important for you to understand it so that you do not lose value. Your assets does not lose value. You don't subject your assets to lower returns. You don't subject your wealth to lower returns. Understanding reinvestment risk and understanding how to mitigate it specifically will help you in your journey towards attaining financial freedom. It's going to help you to maximize your returns on your investments. And that is what a wise investor will do. Have you subscribed to the channel? Please do subscribe. Leave me a comment in the comment section. Let me know what you think about reinvestment risk, and let's meet on the next video.